All right, let's talk about that moment. You know the one. Your trade goes south, it smacks your stop loss, and you get that horrible pit in your stomach. Well, today we're going to break down a really cool strategy that flips that exact moment of failure into a huge win. It's called the art of the U-turn, and we're diving in right now. So how in the world do you pull a 125% profit out of a trade that just stopped you out for a loss? I mean, it sounds completely impossible, right? But that is the exact result we're going to look at. And this isn't about getting lucky. It's a specific technique you can actually learn. And this quote, this right here, gets you into the mindset behind this whole thing. It's about being dominant, being ready to pounce no matter which way the market breaks. It's not about just being a bull or a bear. It's about being a king either way. Okay, let's get right into the play-by-play of this jackpot trade. And the story starts at a moment of, maximum fear, right after the market had already taken a massive nosedive. So here's the scene. The market had just cratered 500 points. Everybody's thinking it's going to keep falling. So the trade was a put option, basically a bet that the market was going to go even lower. The expectation was, hey, more pain to come. Now, real quick, for anyone who's maybe a little new to this, a stop loss, or SL, that's your safety net. It's the eject button you set beforehand to automatically get you out of a trade and limit your losses if things go wrong. Absolutely crucial. And boom, this is what happened. The market just nudged up enough to hit that stop loss at 25,440. Now, for 99% of traders out there, this is game over. You take the loss, you feel bad about it, and you move on to the next trade. End of story. But here's where everything changes. Instead of seeing this as a failure, the strategist saw it as a giant flashing sign from the market itself. The stop loss getting hit wasn't a loss. It was the market whispering, "Psst, I'm actually about to go up." And here is that U-turn in all its glory. The second that stop loss on the bearish put option was triggered, they did a complete 180. They immediately bought a call option, a bet on the market rising at 144, and then rode it all the way up to 324. An absolutely perfect reversal. So we've seen what happened, but let's get into the why. What's the logic that powers a move that feels so counterintuitive? Let's get under the hood of the art of the U-turn strategy. I love this football analogy. It makes so much sense. Okay, think about it. The bears, the sellers, are on the attack, driving the ball in the market, downfield. Your stop loss, that's your best defender making a perfect game-saving tackle. And the second you have the ball, what do? You don't hesitate. You launch an immediate, lightning-fast counterattack by buying that call option. So you see, the whole point is this. Your stop loss isn't just a safety measure. In this strategy, it is the starting gun. It's the signal that possession has completely changed hands, and how fast you act on that signal, well, that's what determines just how big your win is going to be. Okay, so that's the big idea. Now let's bring it down to earth. How does this translate into a real, actionable game plan for the next trading day, Monday, February 23rd? First things first, right now, the market is basically walking this tiny 40-point tightrope. We call this a no-trade zone because inside this range, it's just unpredictable noise. The smart play is not to guess, it's to stay on the sidelines and wait for the market to show its hand and break out, one way or the other. And when it does break out, here's the plan. It's super simple, two sides of the same coin. Plan A, if we break and hold above 25,600, you go bullish, you buy calls. Plan B, if we break and hold below 25,560, you go bearish, you buy puts. And notice how the stop loss for each plan is just the other side of that zone. It's perfectly defined. So, once you're in the trade, what are you looking for? These are the price targets. Think of them like checkpoints or stepping stones. For Plan A, you're looking for 25,627, then 25,667, and so on. Same for Plan B on the downside. This gives you a clear roadmap to manage the trade as it plays out. Okay, so that's the plan for Monday. Super tactical. But let's zoom out a little bit. What's the bigger picture? What's the mega vision for where we could be headed for the whole month of March? So if we stay bullish and break out to the upside, these are the major levels to watch for March. Think of these as the big boss levels, the major ceilings of resistance. Getting through 26,078 and especially 26,333 would be a huge deal. But if plan B takes over and things turn bearish, then these are the levels you gotta watch below. These are the critical support floors. And a break below these, especially that 24,965 area, could signal a much deeper drop for the rest of the month. We've looked at the trade, the strategy, the future plans, but honestly, none of that stuff matters without this final piece. And it is, without a doubt, the most important part of the entire puzzle, your mindset. And this really says it all. The market's going to do what it's going to do. It's going to rise, it's going to fall. Your job isn't to feel your way through it. Your job is to have a plan based on clear levels and to execute that plan like a machine. You have to trust the levels, not your emotions. So I'll just leave you with this question to think about. The next time the pressure's on, when the market is going crazy and maybe your stop loss just got hit, what are you going to listen to? The fear that's screaming in your ear, or the clear, objective levels you laid out in your plan? The answer really does make all the difference. Thanks for tuning in.
All right, hello and welcome. Today, we are diving deep and building a really clear strategic playbook for one of the most exciting and, volatile things you can trade, the Bank Nifty. If you've ever felt just kind of overwhelmed by its speed, well, this whole explainer is designed to give you a solid plan of action.
The source material for this just nails it with this one metaphor. Think about it. If the Nifty index is your everyday reliable car, Bank Nifty is a full-blown race car. We're talking something that can just fly 500 points in the blink of an eye. Now that speed is absolutely thrilling, but you got to know how to handle the machine, right?
And let's be real for a second. That raw power, that huge volatility, it can be pretty intimidating. It makes total sense to look at those wild price swings and feel a little bit scared to even get behind the wheel. But here's where we flipped the script. That volatility, it isn't just risk. If you have a map, if you know the exact levels to keep an eye on, that incredible speed becomes your biggest advantage. It's where the most massive opportunities are just waiting to be found. So here's our roadmap. We've already met our race car. Next, we're going to learn how to handle its speed breakers. Then we'll get super specific with a game plan for this Monday, zoom out to look at the big targets for March, and wrap it all up with the one rule you absolutely have to follow to stay in the race. Okay, first things first. Let's get our foundation solid by talking about these speed breakers. And honestly, it's a brilliant way to understand two of the most fundamental ideas in trading: support and resistance. So think of resistance like a speed breaker on the road when you're speeding up. It's a price level, a ceiling that kind of forces the market to slow down as it's climbing. The key thing for you to remember is this: when you see the price getting close to a resistance level, that's your signal to be careful and maybe think about taking some profits off the table. And then you have the flip side, which is support. If resistance is a speed breaker, then support is kind of like a cushion, or maybe even a trampoline. It's a price floor that's there to catch the market when it's falling, and a lot of times it'll cause it to bounce right back up. It's where buyers tend to jump in. All right, enough theory, let's get specific. Here are the key levels, the speed breakers, and the cushions you need to have on your chart for Monday. As you can see, we've got 5 different resistance levels above us and 5 support levels below. You're going to want to watch the market very, very closely as it gets near any of these numbers. So now let's see how all of this comes together into a real, actionable strategy. This is really the heart of it all, your game plan for Monday, with the specific points for getting in and getting out. Now, before you even think about placing a trade, you have to know where not to trade. We're calling this the no trade zone. It's this 60-point range right between roughly 61,132 and 61,194. Think of it like this. Inside this zone, our race car is in neutral. We don't know which way it's going to go, so the smartest thing to do is just wait on the sidelines.
So here's plan A. This is for the bulls. If the market shows some real strength, breaks above that 61,194 level, and holds there with a green candle, that is your green flag to go. Your move is to buy call options, which are basically bets that the price is going to keep going up. You've got 4 clear targets to aim for, and most importantly, your protection, your stop loss is set at the bottom of that no trade zone. Super clear. Risk is defined. Love it.
And of course, for every plan, you need a counter plan. This is plan B, the bearish case. What if the market shows weakness and breaks below 61,132? Well, that's your red flag. The action here is to buy put options, which are bets the price will go down, or you could sell. And again, you've got a ladder of targets to watch on the way down, and your stop loss is placed right at the top of the no trade zone.
Okay, so that's our short-term tactical plan. But good trading also means having a strategic view. So let's zoom out now. Let's look at the bigger picture and see what the potential mega targets are for the whole month of March.
For those of you who are positional traders, looking at the monthly expiry, if the bulls stay in control, the potential upside is huge. Once we clear those first few hurdles, the next major zones to watch are around 62,000 and 62,500, and the peak potential for the month, all the way up near 63,244.
But what if the bears take over? Well, if the market breaks down through major support, you'll want to watch for a potential slide down towards 60,446 and then maybe even 59,863. And in a scenario where there's really strong selling pressure, a deep fall towards 58,679 is not out of the question this month.
So we've gone over the levels, the daily plan, the bigger picture. But all of this, all of it, is completely useless without this final, most important piece of the puzzle. And that is the ultimate trading rule. Discipline is everything.
This entire strategy, everything we've talked about, it all boils down to one single non-negotiable principle. You should not take even one single trade without a stop loss. This is your seatbelt in the race car. It doesn't stop you from being wrong, but it can prevent a catastrophic wipeout. It is the absolute foundation of managing your risk.
And that really brings us to our final thought. This explainer gives you the map. It gives you the playbook. The levels are right there on your chart. The plan is crystal clear. But the most important question is the one you got to ask yourself. Is the discipline in your mind? Because a perfect strategy isn't worth a thing without the discipline to actually execute it flawlessly.
இந்த வீடியோ உங்களுக்கு பிடிச்சிருந்ததுன்னா லைக் பண்ணுங்க, ஷேர் பண்ணுங்க, சப்ஸ்கிரைப் பண்ணுங்க. Thank you for watching.